Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to talk about the good and the bad of today's market. Maybe not the good and the bad. Maybe I should have titled it like the optimistic vantage point of the market and the pessimistic vantage point. Okay, so I'm going to basically make an argument for, hey, the market's doing fine. We're probably close to a bottom, and it'll do great going into next year. And then I'll take the opposite approach, play devil's advocate, and say, no, here are all the reasons why the market's in bad shape. So I'm going to give both sides of the coin here. What do you think? Leave a comment below and tell me which side do you fall on, and we'll see if we can get a good conversation going. All right, let's go through this. All right, so the overriding question, the only question that we constantly have to ask ourselves right now is this a very normal bear market, or will this be much worse? Okay, if it's a very normal bear market, the market tends to drop 20-25%, maybe a little bit more, and then it'll bounce. It'll bounce. It'll do fine. 6 months later, 9 months later, it'll be back to business as usual, and everything will be just fine. But if it's much worse, then we're looking at something that's probably more in line with the financial crisis or the dot-com bubble. So that's the question we have to ask ourselves. Is this a very normal bear market, or is this going to be something much worse? So let's go through an argument for both sides. All right, first for the argument of this is a normal bear market. Yes, things suck right now, but they'll be fine going forward. So this is from LPL Financial. What this is how the market does after a midterm correction. Okay, the market tends to correct during midterm years, but then it tends to do very well after midterm years. Okay, so here are all the years from 1950 to 2014. I don't have the 2018 data here. So it's every 4 years for, since 1950. Here are the midterm year pullbacks. Okay, every year there's a pullback. The average is about 17%. Okay, so pretty decent size pullback for a year, certainly much greater than normal. But 1 year after the low is put in place, you have 100% gains, with the average being 32%. Okay, not only do you have 100% gains, 32% average, only 1 year, which is 2014, the market rallied less than 10%. Otherwise, you have a lot of 30 and 40% rallies in here. Okay, so it's normal to get a correction during midterm years. The correction averages about 17%, but once a low's in place, the market's up 100% of the time with an average gain of 32% when you're looking out 1 year. So that's reason to be optimistic right now. Next set of numbers. This is from Ryan Dietrich. These are in the last slide, I talked about like how well the market does a year after the midterm low is in place. This chart pinpoints the actual election day, as opposed to just picking the day the low is in place. So even if you just randomly say, like, we're just going to pick it on the election day, the market could have bottomed before that. It could have bottomed after that. But if you pinpoint election day as the starting point, going back to 1946, 100% of the time the market was up. A year later, and the average, which is the last column here, was 14.1%. Okay, there are a couple small years. That's less than 1%, less than 2%. We got 2%, less than 5%. So there are a couple small years, but you got an average of 14%, and you definitely have some big double-digit gains a year after the midterm election date. So that's something to look forward to. All right, next up, this is courtesy of Ned Davis Research. This is after declines of 15% in a quarter, what does the S&P tend to do? So this past quarter, Q2 of 2015, which would have been April, May, June, the market was down 16.5%. Okay, might not be too easy to read, but since 1946, this is post-World War II, these are all the times we've had a down 15% quarter. And this is Q2 of 2022 this year. Okay, so the next quarter, that's what this next column is, the next quarter, which would have been July, August, September, the market was up 7 of 8 years. Cross out this stuff. We're going to do it like these post, whoops. We're going to look at post World War II data. Okay, and that's what it is. So post World War II, the market, the next quarter, after being down 15% in a quarter, the next quarter is up 7 of 8 times with an average median gain of just over 6%. 2 quarters later, the market's up 100% of the time. There are no losses here. And the average gain is 15%. 3 quarters later, again, 100% of the time we have gains, average gain 25%. And 4 quarters later, again, 100% of the time the market is up with the average gain being 26%. The lone blemish on this data is right here where the market, and this is during the financial crisis, where the market was down 11.7% 1 quarter later. And interesting is that this was, that data point was taken at the end of 2008. Market did really poorly first quarter 2009, but it actually also bottomed in 2000, that first quarter in March. So this tells you when we have a really bad down quarter, historically the market has bounced back most of the time the next quarter and definitely the next 2, 3, and 4 quarters. Okay, so it's something to look forward to. Probably not going to have an up quarter this year or this quarter because we're going into the end of September and the market's down near its lows. But if this data holds, there's a pretty good chance with the fourth quarter will be pretty good. So it's another reason to be optimistic. Next one, this is a little bit hard to read. This is courtesy of LPL Financial. So this is how well stocks do after a correction. A correction is defined as a 10% drop, and this data is from 1980 until like 2020. Okay, so here are all the dates where we had a 10% drop. This column here, and I know you can't read this, you don't need to read the numbers. This column shows what the drops are. The average and median is down here. It's about, the average is about 19%. The median is about 17%. Okay, all the quarters since 1980, you can see the red column, average is about 19%. 1 year later, this is the data for 1 year later, the market is up 90% of the time with the average being about 23%. 2 years later, the market is up 87% of the time with the average being the average being about 37%. The only red in these 2 columns here, here, 3 data points there, and 1 there. The only red was during the dot-com bubble and during the financial crisis. So it goes back to my original question, are we in a very normal bear market or is this something much worse? If we're in a very normal bear market, this would suggest we have extremely high odds that the market's going to be up a year from now. Not now, because we've already been in a correction for a while. Much worse than a correction. We're in a bear market. But it's very high odds that the market's going to do well going forward looking into 2023. But if this is much worse than a normal bear market, okay, if it's more like the dot-com bubble or the financial crisis, then we might have some more red data points in these last 2 columns, which is what we got back then. Okay, so it's reason to be optimistic if this is a normal bear market. Okay, so to sum up this, if this is a very normal bear market, the odds are high the market posts big gains 1 year after a midterm low, 1 year after a midterm, the actual date, and several quarters after a 15% quarterly drop, and 1 and 2 years after a correction low. So there's a lot of data that says, hey, as bad as things are, it's fine. There are really good odds that the market is not only going to be up a year from now, but actually up pretty big. Now let's look at the opposite case. What are some things that are stacked against the market right now? What are some reasons that this is not going to be a normal bear market, that it's actually going to be much worse? So 1, the Fed, okay, they are aggressively raising rates into this bear market and recession, and yes, we're in a recession, and they're removing money from the system via quantitative tightening. Another item is the leaders aren't leading. Okay, Apple's doing okay, but Microsoft, Google, Amazon, Facebook, not doing well at all. Some of these stocks are at lows, have been trending down for many, many months. I do not expect these companies to lead in the next bull market. Okay, they'll do fine. Okay, especially since they've been beaten down. Amazon will probably double. It's a really good, safe bet once the market bottoms. but these stocks aren't going to go up 5x, 10x. Okay, so they're still leaders with regard to the fact that they are highly influential, but they're not going to lead the next bull market. But regardless, they're just not doing that great right now. And typically, you can tell the health of the market by looking at the leaders. Next up, China is treating COVID like it's April 2020. Okay, they still have cities there that are in lockdown mode, that they're like quarantining people. It's a great country by many measures, a lot of great technology, a lot of great companies, but the government has backed themselves into a corner by treating COVID like it's a major issue, which it's not anymore. And in the interest of saving face, they just can't admit they're wrong. And it's a disaster over there. And speaking of disaster, Europe is a disaster. Okay, inflation is much worse in Europe than it is in the U.S., and they might have an energy crisis this winter. Okay, we kind of take it for granted here in the U.S. because we are pretty much energy independent. But in Europe, they depend. Parts of Europe depend on energy from outside their countries, and the price of oil, natural gas is up so much over there that they're going to have they could have a full-blown crisis this winter when the temperatures drop. This is the annualized volatility. Okay, you can see through the first 178 days of the year, compliments of Charlie Bellello. So what stands out the most, these are the 15 highest annualized volatility prints going back to the Great Depression. What stands out most is number one is Great Depression, COVID, Great Depression, financial crisis, coming out of the Great Depression, going into World War II, Great Depression, dot-com bubble, Great Depression, coming out of the Great Depression, going into World War II, dot-com bubble, financial crisis, coming out of World War II. So if we're wondering, is this a normal correction or is this something much worse? We're getting prints like this where the only time we've gotten similar prints historically have been during the financial crisis, the dot-com bubble, the Great Depression. So it's like not good company to be in. Okay, it just isn't. So this is a reason to believe that this might be worse than a normal bear market. Here are some more stats. Again, compliments of Charlie Bellello. This is the aggregate return. Okay, which means stocks and bonds. Typically, a market does great. The market does pretty good. Bonds do okay, et cetera, et cetera. But during periods where the market doesn't do well, money comes out of stocks and goes into bonds. And if you have a mixed portfolio, it's you don't do that badly. You can see going back over the last 50 years, we had a negative year in 1994, negative year in 99, 2013, 2021, but they're all small negative years. Even during the dot-com bubble crash, we actually had the aggregate return was positive. During the financial crisis, the return was positive because just people who, if you invest in bonds and stocks, you don't do as during the good periods, you don't do as well when the market is just up, but during the bad periods, your return with bonds tends to counter the loss with stocks. So this year we have bonds going down and stocks going out, so there's absolutely nowhere to hide. The market is there's nowhere to hide. This is the worst aggregate return we've had in the last 50 years. At some point in time, people are going to get pinched. Okay, a negative wealth effect is going to take place, and people are going to get pinched and be a little bit gun shy, and that's just going to have a ripple effect through the economy. Housing is topped. Okay, everyone kind of knows this. At first, it's not a big deal. I can tell you here in Colorado, there were places that were just outrageously priced. I keep tabs on real estate in my area and up in the mountains near the ski resorts. And housing that would like steadily increase in price, just a couple percent a year, just normal stuff, just went vertical, like doubled over the course of like 2 years, just completely unsustainable. So the fact that it would come down a little bit is fine because it really never should have gone that high in the first place, but it's continuing to come down and there's no sign that it's bottoming. So another negative wealth effect, element that's in the camp of those who believe this is going to be worse than a normal bear market. Okay, next up is the 10-year Treasury note, getting awfully close to 3% or 4%. At some point in time, bonds are going to become competition to stocks. Okay, I've already seen CDs nowadays. There are some CDs that if you're willing to go out like a year or so, you can get a 4% CD. And at some point in time, people are going to say, hey, instead of rolling the dice with the market, I'd rather just get a CD. There's zero risk, 4%. I'd rather lock that in. So the higher rates go, the more competition there's going to be for the stock market. Okay, it's pretty bad that the market has done as poor as it has with rates being this high. If rates continue higher, eventually people will be like, screw this. I'm just going to buy bonds, treasuries, lock in my, have no risk and lock in my return, and I'm not going to worry about the stock market. So this goes higher. I don't know where the threshold is. I don't know if there's a magic level that once crossed, it's going to result in people getting out of the market en masse. But it is going to become competition at some point in time. All right. So to sum this up, we're in a bear market and a recession. The Fed is raising rates and removing money from the system. The bond market is weak. So is housing. China's a mess. Europe may have an energy crisis this winter. Okay, and of course, so going into this, the question remains, like, is this a very normal bear market? If it is, we've already fallen 20-25%. We've already suffered a lot. It's already lasted a decent amount of time. If this is a very normal bear market where the lows are either in, or maybe we'll push through the lows temporarily, but we're probably pretty close to the lows in terms of both in price and in time. And a year from now, there's really, really high odds that the market's not only going to be up, but up a lot, like 20%. But if this is not a normal bear market, if it's something much worse, then we might only be halfway through. Everything that's taken place so far might only be the right side of a big topping pattern, and we might only be halfway through, and we might have a lot more downside to go. Okay, so that's my optimistic view and pessimistic view. What do you think? Let me hear what you think down in the comment section below. Share the video with your friends via email, via Twitter. Help me spread the word. I'm kind of curious what you guys are thinking. All right, thanks for listening, and I'll see you next time.